Welcome to TaxLawGH and welcome to our video, our third in the series for employment income taxation. In this video, we continue from where we left off in part 2, where we continue to look at the different benefits, the different gains that an employee can make from a typical employer-employee relationship. It's important, I highly recommend that you watch parts 1 and 2 of employment income before you watch this video, as they have built a certain foundation you need to establish before you look at these concepts. Today we are looking at one common benefit most employees, not most actually, one benefit a number of employees receive from their employment, which is a motor vehicle or a car benefit. So here we are saying it's a benefit that consists of the availability for use or the use of a motor vehicle which is provided by an employer to an employee or by an entity to a member or manager of the entity during the year. And the principle here is, we say if the company gave you money to buy a car or they gave you fuel allowance in cash, it's simple. If they gave you 100 cedis, we'll tax you on 100 cedis. If they gave you 1,000 cedis, we'll tax you on 1,000 cedis. It becomes quite complicated where instead of physical cash, the company actually gives you a car or a benefit in kind, not in cash. So they give you a company car and they give you fuel every month or every week. In that case, we don't know which value to place on that benefit for tax purposes. Don't forget that the principle in employment income is, as long as you've made a gain or a profit from an employment during a year or for part of a year, we need to find a way to tax you. The principle again is, if let's say you have a friend, your friend works in a bank and the bank provides your friend with a company car. You, on the other hand, you probably work with a retail company. The retail company doesn't give you a car. Your friend is enjoying a benefit you are not enjoying. Your friend's benefit is enjoying is because or it's as a result of the current employment he's exercising. So it means if not for the fact that he was working with that particular bank, he wouldn't have received a car. So we need to find a way to establish that he's enjoying the benefit and he must be taxed on that benefit. What the law does is, where you are given a benefit in kind, the law gives guidance, provides rates. You can find this in the 4th schedule of the Income Tax Act if you're interested. So here, we need to know the 4 scenarios the law presents us with. The first is if you are given a driver, you are given a vehicle, you are given fuel. So the company gives you a car, gives you fuel to fuel the car, and gives you a driver to drive you around. So this is like the highest you could receive, right? So here, what the law says is, it's 12.5% of something called your total cash emolument. So let's explain that first. Your total cash emoluments at the basic level, so that you understand, is the sum of all your benefits received in cash at the fundamental level. So everything your employer pays you in physical cash is part of your total cash emoluments at the fundamental level and for your exam purpose, right? So here, we are saying that when you are given a driver, you are given a vehicle, and you are given fuel in addition, the amount or the benefit to be taxed will be 12.5% of your total cash emoluments. But there's a rule, there's a threshold, there's a cap to this amount. We don't want to tax people unfairly. Think about this. Let's say there's a CEO who has a huge salary. And if we apply this rule without capping the amount of the benefit, we'll end up taking 12.5% of all his plenty cash, if I can use that expression, and we'll tax him unduly on such a huge amount. So what the law says is, we'll compare 12.5% of total cash emolument, but we'll make sure that the benefit does not exceed 600 Ghana cedis per month. So this will benefit very high earners because the amount of motor vehicle benefits will be capped at only 600. It will be limited to 600. It will not exceed 600. So what you need to do when you're computing this in exam or in practice is you pick the total cash emoluments figure, you compare or you compute 12.5% of that figure, you put the figure aside, and then you compare that figure computed to 600 Ghana cedis per month. If the figure is less than 600 Ghana cedis, use the lower figure. If the figure you computed, which is 12.5%, is higher than 600 Ghana cedis, then use 600 Ghana cedis. The summary of the point here is, at all times, the motor vehicle benefit cannot exceed 600 Ghana cedis for someone who gets a driver with a vehicle and fuel. Scenario 2 is where there's no driver. You just get a car and fuel. Here, the 12.5 changes to 10%, and the 600 Ghana cedi cap drops to 500 Ghana cedis per month. Scenario 3 is where they give you just a car with no fuel and no driver. Here, the 10% drops to 5%, half of it. The 500 Ghana cedis is also halved to 250 Ghana cedis maximum per month. Final scenario is where you are given only fuel, so probably fuel coupons or whatever means. Maybe you have your own car, so your employer decides to just fuel your car for you. In that case, it's the same as vehicle only, which is 5% of total cash emoluments up to a maximum of 250 Ghana cedis per month. So remember, driver vehicle fuel is 12.5% of total cash emoluments up to a maximum of 600 Ghana cedis per month. Vehicle with fuel is 10% of total cash emoluments up to a maximum of 500 Ghana cedis per month. Then vehicle only and fuel only are the same. Both of them are 5% of total cash emoluments up to a maximum of 250 Ghana cedis per month. The next benefit we'll look at is accommodation benefits. What we just looked at is motor vehicle, where they give you a car with driver, vehicle, fuel, and all of that. The next is, this is where they give you company house to live in, or the company provides a house for you to go and live in. Take note once again, if your employer gives you physical cash to go and pay your rent, that is simple. If he gives you 5,000 cedis every month as rent allowance, then we'll tax you on 5,000 cedis. No problem with that. It becomes an issue where he gives you the house to go and live in. So we need to find a way to value the house to tax you on. Similar to the story I gave you about your friend working in a bank and you working in a retail company. If your friend working in a bank gets a company house to live in, probably a 3-bedroom house at Trasako somewhere, he's benefiting something you are not benefiting from. So we must find a way to make him pay tax on that benefit, contribute his quota to national development from that benefit, right? So here, your employer has given you accommodation. So you're saying it's a benefit consisting of the provision of premises by an employer for residential occupation of an employee during a year of assessment. Here, there's no cap. So remember, it's just the motor vehicle benefits that have a cap on a monthly basis. Accommodation, we don't care. We don't care how big your total cash emolument is. If you are not lucky, it will become bigger than usual. So if scenario number 1 is where your employer gives you accommodation with furnishing. So this is a fully furnished apartment or a fully furnished house. So you go into the house, there's a flat screen, OLED, 65-inch LG TV. You have furniture in the room. There's everything in the house already. It's a fully furnished apartment. In that case, the law says we will pick 10% of your total cash emolument, and that will be the benefit for tax purposes. In other words, this is the benefit or the amount we add to your income to tax for the period. Scenario 2 is where we give you just the house with no furnishing. So it's an empty shell. You just buy your own stuff and move in. Or if you have your own furniture, your own TV, your own kitchen set, you move in with them. In that case, the 10% drops to 7.5% of your total cash emolument. Remember, there is no cap for accommodation benefits. What you see is what you get. The third is where they give you furnishing only. So here, the company decides to buy you furnishing. So whether it is your living room set, your kitchen set, or whatever you deem furnishing, the company provides just that without the house itself. So let's say you have your own house and the company provides just the furnishing. The 7.5 will drop to 2.5% of total cash emoluments. The final scenario is shared accommodation. This is where the company gives you an apartment. Probably it's a flat per se. So you have a company flat and maybe you share some portion of the building with another co-worker. It's a shared premise, the shared accommodation. In that case, it's 2.5% of the total cash emolument. Some people ask questions such as, what if it's a furnished shared accommodation? the law doesn't care. It just said shared accommodation is 2.5. So it can be fully furnished, but it is shared, right? So we pick the substance of our form. Yes, it is furnished, but is it shared accommodation? If yes, then 2.5 of total cash emolument. So this is what you are supposed to remember by way of accommodation benefits. Now, still on accommodation benefits, if you remember from our earlier series or our earlier sessions on employment income from part 1 and part 2, we mentioned that when it comes to, I think that was part 1, when it comes to the amount that should be excluded from employment income of an employee, we said employ or accommodation provided by an employer at the location or the site of the business for certain industries or businesses were to be exempt from tax. So we mentioned businesses like timber, mining, building, construction, farming, petroleum operations. Anytime the company provides you with accommodation on the site or on the premises of the business operations, we are saying we are going to waive the accommodation benefit and let you go scot-free. And the rationale really is, like I said in the earlier video, instead of being at home with your family in an air-conditioned apartment, relaxing with your wife, children, or with your husband and children, you are living on the mine site. When there are explosions underground, you hear them. If you are living on a construction site, the dust all around. Like, it's enough inconvenience to live on the site of these kind of businesses. So the law is saying, you know what, it's enough stress, I'm waiving your tax. That's what I think the rationale really is. This particular slide provides extra clarity on that provision. Remember, that provision can be found in section 4 of Act 896. This clarity is provided by Regulation 18 of LI 2244, that is the Income Tax Regulations of 2016. What Regulation 18 tells us is, like I said, it throws more light on what section 4 already said. So this says, where accommodation is provided by an employer to an employee, the Commissioner General shall treat any amount deducted by the employer as rent expenditure as expected. So on the company side of accounting for taxes, they'll get a deduction as rent expenditure, or the amount paid by the employer for renting of that expenditure as part of the income of the employee and tax the amount. So all things being equal, one person must bear the tax. That's the rationale here. Right? We are saying the above does not apply where an employer carries on a timber, mining, building, construction, farming business, or petroleum operations and provides accommodation for an employee at a place or site where the field operation of the business is carried out. So you must be given actual accommodation on the site. Let's continue. I'm saying, despite the above, the Commissioner General shall treat as additional income earned by an employee any cash payment made by an employer to an employee in lieu of accommodation and tax the amount accordingly. What we are saying here is, if the employer makes the mistake of giving you physical cash, it is taxable. We don't care whether your house is on the site. Once in place of actual accommodation to live in, your employer gives you actual cash to go and rent your own place, it's taxable. You can't argue with that because you've been given cash to do what you want to do with it, right? So that is the rationale for this exemption for living on the site to apply. It must be you actually being on the site, living on the site. Cash payment doesn't count. So you can't say I'm a mining company and I paid my employees accommodation allowance, so it's exempt. No, they must live on the site. And to even ensure companies don't play with this provision, the law provided what it meant or what it actually implied to live on the site. So it said an employee is provided accommodation at a place or site where the location of the accommodation is in close proximity to the physical location used for the business operations, taking into consideration other factors, including the safety of the employee from health hazards associated with the business. So we are saying here, the law gives some little room for companies to maneuver. They use the expression close in proximity. So they are saying that wherever the accommodation is, must be very close to the business operations. but they are allowing you to consider factors such as health hazards and stuff. So if it's a mining company and for some reason there are dangerous chemicals used in the mining operations that sometimes will be in the atmosphere and can harm employees and children, we are saying that take into consideration that health and safety regulation and move the accommodation as far as possible from the actual site, but make sure it is close to the site. So you can't have your mining operations in Accra and the accommodation is somewhere in Kaswa. It doesn't make sense. That is not close proximity. It must be close enough for us to say you are on the site. Just that take into consideration that you mustn't be underground with where the miners are for us to say you're on the site. You must be close enough to the site, but not so far away that it doesn't even make sense. So this is what it means when it comes to the accommodation provided on a site for a business. Now, the next thing we'll look at is loan benefits. This is where an employer provides a loan, what some people call a soft loan, to an employee at below market interest rates. This is what the law seeks to tax essentially. You know, there are a number of people who work with banks, and because they work with the bank sometimes gives them a loan at 0% interest, or sometimes 1%, sometimes 5%, sometimes 10%, whereas the market interest rate might be maybe 19 or 25%, 24%, depends on the time of the year and which bank you're talking to and your credit worthiness and all of that. So because the employee is getting a specialized loan interest rate, it's a benefit, because don't forget that if not for the fact that the person was working in a bank, they would not have benefited from such a loan benefit. If you were going for a loan from that same bank, they'll charge you market rate or they'll charge you commercial rate. So if that person's enjoying lower rates, they must pay tax on that benefit. But the law gives us some conditions to go through to establish whether or not there is a benefit to tax. It's not a hard and fast rule that when your employer gives you a loan, you must pay tax on it. No, there are a number of steps to go through. So we are saying here that a benefit that consists of a loan provided for a year of assessment in return for services, that's like employee, whether by way of an employment or otherwise, or by an entity to a member or manager of the entity, is quantified as below. So we have three things to remember. First thing is the loan must be from the employer to the employee. Take note, it must be your employer giving you the loan as an employee. The next is the term of the loan must not exceed 12 months. So it must be a short-term loan. It's a loan that probably your company gave you that you must pay back in the next 7 months, in the next 4 months, in the next 9 months, in the next 11 months and few days, but it must not exceed 12 months. So in the actual sense, it must be a short-term loan, or if you're an accounting firm, it must be a current liability to you, something that is payable within 1 year. And the final point is the aggregate amount of the loan and any similar loan outstanding at any time during the previous 12 months should not exceed your 3 months basic salary. Let me break this third point down for you. We are saying that this current loan you've taken from your employer, let's say you took a loan of 1,000 cedis, and you already owe a previous loan you've not paid off of another 1,000 cedis. So you've gone for a loan of 1,000 cedis. You had a previous loan of 1,000 you've not paid off, right? We are saying the aggregate amount of this loan, which is the current 1,000 cedis, and any similar loan outstanding, which is the previous 1,000 cedis you went for, right? The sum of the two at any time during the past 12 months should not exceed your 3 months basic salary. So what is your basic salary per month? If your basic salary per month is, let's say, 200 Ghana cedis, if I multiply 200 Ghana cedis by 3, it will give me what? 600 Ghana cedis. And that 600 Ghana cedis will be my 3 months basic salary. You can see that in the example I just gave, my aggregate amount of the loan 1,000, the similar loan outstanding, another 1,000 giving me 2,000, exceeds my 600 Ghana cedis. So I've broken this rule. But let's say in a case where the loan amount, so let's swap the figures. So let's say the current loan amount I have is 200 Ghana cedis. The previous loan I've not paid off is also 200 Ghana cedis, making what? 400 Ghana cedis. So the aggregate amount of the loan and a similar loan is 400 Ghana cedis, right? And my 1 month basic salary is 1,000 Ghana cedis, right? So 3 months basic salary will be 1,000 times 3, giving me what? 3,000 Ghana cedis. When I compare the 400 Ghana cedis to my 3 month salary, basic salary of 3,000, it does not exceed it. So I'm fine. So we are saying that where the loan is from an employer to an employee, where the loan is a short-term loan and doesn't exceed 12 months, and where the sum of the loan and any similar loan you've already taken from the employer during the past 12 months does not exceed your 3 months basic salary, the quantity of the payment is nil. You don't owe any benefit on this loan. We'll tell you to, you know what, don't pay any tax on this loan, just go home scot-free. That's what this means. So you must meet these three criteria for your loan benefits to be exempt from tax. What happens where you break any of these? When you break any of these, you must, because don't forget that it is where the first, the second, and the third. It's not where the first or the second or the third. You must meet all three. So if you break just one, you are liable to the benefit on the loan. Remember, it's not an or condition. It's A and B and C, not A or B or C. So you must meet all three for the benefit to be zero. If you break any of them, you have a benefit to pay. How do you compute that benefit? The law provides an answer. It says 1/4, that is 1/4, of the amount by which, one, if interest were payable under the loan at the statutory rate for the year of assessment, the interest that would have been paid by the payee, that is you, the employee, during the year of assessment in which the payment is made, the amount by which it exceeds the interest actually paid by the payee during the year of assessment under the loan, if any. It looks long. Let me break it down into an equation for you. We are saying that we want to find a way to tax you on the loan benefit your employer has given you. I gave you three conditions that you're supposed to meet. The loan must be from the employer to the employee. The term of the loan must not exceed 12 months. The current loan amount and any previous loan amount in aggregate should not exceed your 3 months basic salary, all of those things, right? Here we are saying that if you have flouted any of those, we need to find a way to tax you. How do we do it? We are going to assume that if you were paying interest on the loan at a certain interest rate, what would that interest rate have been? So you can see that we are comparing two interest amounts. Look at the first bullet. It's saying if interest were payable under the loan at the statutory rate, I've noted here that statutory rate means the Bank of Ghana rediscount rate. Typically, this would be the BOG monetary policy rate. I think it's currently 14.5%. So this statutory rate is what you will use to determine this amount of loan benefits. We are saying that the first bullet is if you were paying interest at the statutory rate, what would the interest have been? That's the first point. So let's say the loan amount is 1,000. If you were paying interest at the statutory rate on 1,000, what would that amount have been? Put that amount down. Then you deduct, because it says exceeds, right? You deduct any interest that you have actually paid under the loan, if any. So for a 0% interest loan, the payment you would have made would have been zero. What we are saying is that, let's say, in substance, we are trying to establish the interest rate differential. If your employer gives you a loan at 1%, all we are trying to do is tax you on a quarter of the difference between whatever interest rate they gave you and what you should have been paying on the market anyways, right? So here we are comparing if you were paying interest on the loan at the statutory rate minus how much interest you are paying, if any, into brackets times 1/4. So if you want an equation to write down, we'll do more questions on this when we get to the revision stage, when we are done with the tuition part of this and we are solving exam questions. So for now, if you want an equation to revise, it's the benefit is 1/4, which is 1/4, times, you can open a big bracket, into bracket, interest paid at statutory rate minus actual interest paid by employee, bracket close. I'll take that again. The loan benefit will be 1/4 or 1/4, right? Times big brackets. So you open bracket, interest at statutory rate minus actual interest paid by employee, if any, bracket close. This is how you determine the loan benefit. And we are saying that how do you compute the loan benefit? We are saying in quantifying the loan benefit amount, the rate to apply shall be the applicable statutory rate at the time the loan was taken. So when you took the loan, we use the rate there, we fix the interest rate. We don't do a floating rate and check what the rate is today. It's the rate at which, the rate at the time you took the loan. And the loan benefit is required to be determined on a monthly basis. So we add this to your employment benefit on a monthly basis. So let's pause here for now, go through the things we've done, and we will continue in the next session. So for now, run through the things we've done. We've looked at motor vehicle benefits, we've looked at accommodation benefits, we've clarified what it means to be on the field or the site of a business. We mentioned the principle of close proximity, and we've looked at how to determine loan benefits from an employment. So in our next session, we'll continue with personal reliefs, which is a very crucial part of employment income. So don't forget to smash the like button if you love this and share this video within your network. I'll catch you shortly.